Digital Asset Characteristics examines the defining investment features of digital assets within the program. Digital assets are electronically created and transferred assets that rely on distributed ledger technology, DLT, for security, validation, and ownership tracking. Unlike traditional financial assets, digital assets are decentralized and generally operate without direct oversight from central banks or government authorities. The most recognized digital assets are cryptocurrencies, although the category also includes utility tokens, governance tokens, stablecoins, and digital collectibles. These assets are increasingly viewed as an emerging alternative investment class because they offer new forms of value transfer, portfolio diversification potential, and technological innovation. However, digital assets also involve substantial volatility, operational complexity, and regulatory uncertainty. A key characteristic of digital assets is decentralization. Traditional financial systems depend heavily on centralized institutions such as banks, clearinghouses, and payment processors to validate transactions and maintain records. Digital assets instead use distributed ledger technology, where transaction records are maintained collectively across a network of participants. This decentralized structure enhances transparency because all network users can verify transactions independently. It also reduces reliance on intermediaries and may lower transaction costs and settlement times. However, decentralization introduces governance challenges because there may be no single authority responsible for resolving disputes, correcting errors, or managing operational failures. Investors must therefore understand both the advantages and limitations of decentralized financial systems. Digital assets are also characterized by high volatility and speculative pricing behavior. Cryptocurrency values can fluctuate dramatically within short periods due to investor sentiment, market adoption trends, macroeconomic developments, regulatory announcements, technological changes, and speculative trading activity. Unlike traditional securities, many digital assets do not generate cash flows, dividends, or earnings that can be used for conventional valuation analysis. As a result, pricing often depends heavily on supply-demand dynamics and market expectations regarding future adoption or utility. While this volatility creates opportunities for significant returns, it also exposes investors to substantial downside risk. Consequently, digital assets are generally considered high-risk investments appropriate only within carefully managed portfolio allocations. Another important characteristic of digital assets is their reliance on cryptographic security and blockchain technology. Transactions are secured using advanced cryptographic methods that help protect ownership records and reduce the risk of unauthorized alterations. Blockchain systems create transparent and immutable transaction histories, enhancing trust among network participants. However, digital asset ownership is typically controlled through private cryptographic keys. If these keys are lost, stolen, or compromised, investors may permanently lose access to their assets. Cybersecurity threats, hacking incidents, and exchange failures therefore represent major operational risks within digital asset markets. Investors must carefully evaluate custody arrangements, security protocols, and technological infrastructure before participating in digital asset investing. The topic also emphasizes regulatory and legal uncertainties surrounding digital assets. Governments and regulatory agencies worldwide continue developing frameworks governing cryptocurrencies, token issuance, trading platforms, taxation, and investor protections. Regulatory changes may significantly influence digital asset prices, market accessibility, and adoption rates. Some jurisdictions have embraced digital asset innovation, while others impose restrictions or outright bans on cryptocurrency activities. Legal classification also varies, with some digital assets treated as securities, commodities, or payment instruments depending on their characteristics. This uncertain regulatory environment increases investment risk because future rules may alter market structures, compliance requirements, taxation policies, or the legality of certain blockchain-based activities and financial products. Overall, topic demonstrates that digital assets possess unique investment characteristics that distinguish them from traditional asset classes. Decentralization, blockchain technology, cryptographic security, high volatility, and evolving regulatory frameworks all shape the risk-return profile of digital asset investing. While digital assets offer opportunities for innovation, diversification, and potentially significant returns, they also expose investors to operational, cybersecurity, liquidity, valuation, and legal risks that remain difficult to predict. Successful participation in digital asset markets therefore requires strong technological understanding, disciplined risk management, and careful evaluation of evolving market structures. For CFA candidates, understanding digital asset characteristics is increasingly important as blockchain-based financial systems continue expanding within global investment markets and institutional portfolios.